In 1929, the stock market crashed and pushed America into the Great Depression, one of the darkest economic periods in history. Stocks fell almost 90% in just a few years. 1 out of every 4 people lost their jobs. Banks collapsed everywhere, and people who had spent their whole lives saving money watched those savings disappear overnight. Families lost homes, businesses shut down, and it took 25 long years, an entire generation, for the market to recover and return to the levels it was at before the crash. Then came 2008. This time, the crisis started in the housing market. People were given loans they could not afford, and banks created risky financial products that were built on unstable mortgages. When housing prices stopped rising, people could not refinance or make payments. Defaults spread like wildfire, and suddenly the entire financial system froze. Stocks fell 57% in just 18 months. Millions lost their jobs, their homes, and their retirement savings. It took more than 5 years for the markets to climb back, and even longer for ordinary people to rebuild their lives. Now, experts around the world are warning that 2025 might be even more dangerous than both of those crises combined. This time, it's not just the stock market that looks inflated. It's not just housing. It's not just government debt. Instead, all major financial pillars, stocks, housing, bonds, corporate debt, consumer debt, and government finances, are shaking at the same time. Economists call it the everything bubble. When one part of the system crashes, there is usually somewhere else to hide. But when everything begins to fall together, there is nowhere safe left. Most people think this is something new, but in many ways we are standing in the same place America stood in 1928, right before the Great Depression. The only difference is that today's situation is even harder to control because the tools the government and central banks used in the past no longer work. In 1929, the Federal Reserve had room to cut interest rates. Today, rates are already too low to act as a rescue tool. In 2008, the government could borrow money to save the banks and stabilize the system. Today, the government is drowning in $36 trillion of debt and can barely pay the interest on that debt. During the pandemic, the government printed trillions of dollars, and it triggered the worst inflation in 40 years. So printing even more money might push the country into another inflation crisis. Every major financial indicator, the ones that have predicted past crashes with surprising accuracy, is flashing red. Many economists believe the danger window is between November 2025 and June 2026. And if the system falls apart, the crash could be larger, faster, and more damaging than anything seen in modern history. This is not guesswork. It is simple mathematics combined with historic patterns that have repeated again and again. The biggest reason 2025 is different is because we are not living inside one bubble. We are living inside 3 massive bubbles happening at the same time. The stock market is extremely overvalued. Housing is more expensive relative to income than it was in 2008. And government debt is larger than ever before, reaching levels that used to be seen only during world wars. The stock market today is being held up by a small group of giant companies. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla together make up almost 1/3 of the entire stock market. This means the fate of the market depends almost entirely on these 7 companies. If even one of them collapses or disappoints investors, the whole market could fall like a chain reaction. Nvidia alone is valued at more than $3 trillion. More than the entire stock market of Germany, which is the 4th largest economy in the world. Nvidia is a great company, but the price investors are paying for its stock is based on excitement and hype, not just real earnings. People believe artificial intelligence will change the world, just like people believed the internet would change the world in the late 1990s. They were right about the long term, but completely wrong about short-term stock prices. The same mistake is happening again. Real estate is another major problem. Home prices are about 50% above their long-term normal relationship with income. In 2008, at the peak of the housing bubble, homes were only 35% above trend. This means today's housing bubble is around 40% bigger than the one that caused the Great Recession. Many people do not realize this because high home prices have become normal. But the truth is that real estate is stretched far beyond what average families can afford. As soon as interest rates rise or incomes fail to keep up, the pressure becomes too much. Commercial real estate is in even worse shape. Office buildings across major American cities are empty because more people are working from home. Some cities have office vacancy rates over 40%. Many of these buildings were financed when interest rates were low, around 3%. Now those loans are coming due and need to be refinanced at 7, 8, or even 9%. The buildings are not earning enough to cover the new loan payments. That means owners will default and hand the buildings back to the banks. These defaults will create huge losses for regional banks which hold most commercial real estate loans. This looks very similar to the 2008 crisis, except this time the problem is office buildings instead of homes. The bond market, which is supposed to be the safest part of the economy, is also under pressure. In past crashes, people rushed to buy government bonds because they were safe. But now the government owes so much debt that the bond market can barely absorb more. The interest costs alone are over $1 trillion a year, more than the country spends on defense or social security. When interest payments become the largest part of the budget, the government has only painful choices left: cut spending sharply, raise taxes heavily, or print money and risk inflation. None of these choices help the economy. All of them lead to recessions or worse. This situation has never happened before. In 1929, only stock prices were too high. In 2008, only housing was in a bubble. Today, stock prices are inflated, housing is inflated, and government debt is at extreme levels. When a system has too many weak points at once, even a small shock can break everything. The dangerous part is that the system does not need a huge event to collapse. The trigger could be something small: a tech company missing earnings, a regional bank failing, a sudden jump in interest rates, or a political conflict could set off a chain reaction. Once panic begins, it spreads. Automated trading systems start selling. Margin calls force investors to sell more. Institutions sell to manage risk. And soon the market begins falling faster than anyone can respond. A small fall becomes a big fall. A big fall becomes a crash. If stocks fall, bonds fall. If bonds fall, interest rates rise. If interest rates rise, housing falls. If housing falls, banks take losses. If banks take losses, people panic and withdraw their money. If people withdraw money, banks collapse faster. And if banks collapse, the government must step in. But the government does not have the money to do another huge bailout. Unemployment would rise sharply as companies cut costs. Tech companies that hired aggressively during the AI boom would lay off thousands. Retail stores would close as customers stopped spending. Small businesses would suffer the most because they rely on loans and steady cash flow. Many would not survive a prolonged downturn. Young people graduating in 2026 or 2027 would struggle to find jobs. This could harm their long-term earnings for decades. Retirement accounts would be hit the worst. Someone who spent 30 years saving and has $600,000 in a retirement account could watch it drop to $200,000 or even less. That is not a small loss. That is a complete change in their future. They may not be able to retire. They may be forced to work 10 or 15 more years if they can find work in a recession. Retirees would suffer even more because they would have to sell assets at the bottom just to survive. Housing prices could fall by 40 or 50% in many cities. Anyone who bought a home in the last few years might find themselves owing more on their mortgage than their home is worth. Families would be trapped, unable to sell or move. Renters would also struggle because landlords facing higher costs might raise rents or fail to maintain buildings. The government would face tremendous pressure as tax revenue drops, unemployment rises, and more people need help. But the government cannot borrow like it did in 2008, because debt is already at extreme levels. Printing money would risk more inflation, which would destroy purchasing power and make basic goods more expensive. The government would be forced to make painful decisions, cut spending when people need help the most. Political instability often follows economic collapse. When people lose jobs, homes, savings, and hope, they become angry and desperate. They look for someone to blame or someone who promises easy solutions. History shows that economic crises can fuel extreme politics. The 1930s saw the rise of dangerous movements around the world. A similar pattern could emerge again if the economy falls hard. The most worrying part is that this situation resembles both 1929 and 2008, but with added complications. In 1929, only 10% of Americans owned stocks. Today, almost 60% of households are tied to the market through retirement accounts. This means the crash would hit almost everyone instantly. In 2008, the government had room to borrow and rescue failing institutions. Today, that room no longer exists. The government is already paying record interest on its debt. The Federal Reserve had tools in 2008 to reduce rates and inject money. Today, those tools have been used too many times and have lost effectiveness. Countless warning signs are already showing up. Regional banks have quietly been failing since 2023. Commercial real estate values have been falling for years. Consumer debt has reached record highs, and delinquencies are rising. Corporate insiders, CEOs, and executives are selling huge amounts of their own company stock. Even Warren Buffett is holding the most cash in the history of Berkshire Hathaway because he believes the market is too risky. The yield curve, which has correctly predicted every recession for 70 years, flipped in 2022 and stayed inverted for more than 2 years. Historically, recessions follow soon after the curve returns to normal, and that normalization happened in late 2024. This places the highest risk period in 2025 and 2026. If the crash unfolds, stock markets could fall 65 to 80%. Bonds could fall more than 30%, something that did not happen in previous crashes. Real estate could fall 40 to 60%, leaving millions underwater. Unemployment could climb above 15%. And unlike 2008, recovery might not come in 5 years. It might take 10, 15, or even 20 years, just like Japan's 30-year recovery after its 1990 crash. This is why experts call it the everything bubble, because everything is inflated, everything is connected, and everything is at risk of falling together. The crash may not be avoidable. The math suggests it is coming. The patterns suggest it is coming. The signs that have predicted past crises are all pointing in the same direction. The only question left is whether people will prepare themselves before it arrives.